As someone approaching retirement or already navigating life after work, understanding how pension contributions actually function can feel surprisingly confusing. Between defined benefit pensions, defined contribution plans, workplace matches, tax relief, and annual limits, it is easy to worry about whether you are making the right decisions or missing critical opportunities to secure your financial future. When you break down the mechanics of a pension, the system becomes much easier to navigate. A pension is simply a tax-advantaged vehicle designed to fund your life after you step away from full-time employment. How money flows into that pension, and how that money grows, depends entirely on the type of plan you have. There are two primary categories of pensions: defined benefit plans and defined contribution plans. A defined benefit pension is what most people traditionally think of when they hear the word pension. With this model, your contributions during your working years, along with those made by your employer, go into a centralized pool managed by the plan sponsor or institution. The amount you receive in retirement is calculated using a set formula based on factors like your salary history, years of service, and age at retirement. You do not manage the underlying investments yourself, and your final payout is guaranteed for life regardless of market fluctuations. For those approaching retirement with a defined benefit plan, the main objective is understanding your vesting status, payout options, and how options like single life versus joint survivor annuities impact your monthly cash flow. A defined contribution plan operates differently. Here, the final value of your pension depends directly on two things: how much money is contributed over time and how those funds perform in the market. In these plans, contributions are drawn as a percentage of your salary or set dollar amounts, and you decide how those funds are allocated across various investment options like index funds, bonds, or target date portfolios. One of the most powerful aspects of pension contributions during your earning years is the power of matching contributions. When an employer matches a percentage of what you put into your plan, that is effectively an immediate, guaranteed return on your money. Missing out on an employer match during your final working years is essentially leaving earned compensation on the table. Tax efficiency is another vital pillar of how pension contributions work. Contributions made on a pre-tax basis lower your overall taxable income in the year you make them. For instance, if you earn $80,000 in a year and contribute $10,000 to a qualified pre-tax pension plan, your taxable income for that year drops to $70,000. That money then grows tax-deferred over time, meaning you pay no taxes on capital gains, dividends, or interest while the money remains inside the account. Taxes are only paid down the line when you begin taking distributions in retirement, often when you may be in a lower overall tax bracket. Conversely, post-tax or Roth-style contributions work in reverse. You pay tax on the money up front, but qualified withdrawals in retirement, including all the growth accumulated over the years, are completely tax-free. For those in their 50s and 60s, special rules exist to help accelerate retirement readiness. IRS guidelines allow for catch-up contributions. Once you reach age 50, you are permitted to contribute significant additional amounts beyond standard annual limits into workplace accounts like 401(k), S, 403(b), S, or IRAs. Furthermore, recent Secure 2.0 legislation created enhanced super catch-up limits for individuals between ages 60 and 63, allowing an even larger bump in tax-deferred savings right before stepping into retirement. A common concern for people nearing retirement is what happens if they continue working part-time or consulting after starting to draw from a pension. In most defined contribution settings, continuing to work allows you to keep contributing earned income to build your balance further. However, with defined benefit plans, re-entering employment with the same employer could temporarily pause benefit payouts, making it essential to review plan rules before taking on new work roles. If you are currently evaluating your pension contributions as retirement nears, here are 4 actionable steps to take right now. First, request an updated pension statement or benefit estimate from your plan administrator. Verify your total contributions, current account value, vested status, and projected monthly benefits at various retirement ages. Second, audit your current contribution rates. If you are still working, ensure you are at least contributing enough to capture 100% of any available employer match. If you are age 50 or older, evaluate whether you can utilize catch-up contribution limits to optimize your final pre-retirement tax years. Third, clarify the tax structure of your accumulated pension funds. Determine what portion of your balance consists of pre-tax dollars versus Roth or after-tax contributions. Knowing this distinction allows you to create a tax-efficient withdrawal strategy once you begin taking distributions. Fourth, review your asset allocation inside defined contribution plans. As retirement approaches, your priority often shifts from aggressive capital growth to capital preservation and income generation. Adjusting your investment mix to reduce downside volatility can help protect the funds you have spent decades building. Understanding the mechanics of your pension contributions takes the guesswork out of retirement planning. By knowing how your money goes in, how it grows, and how taxes apply, you can make confident, informed decisions that protect your income and support the lifestyle you want in retirement.